Hey everyone, it's me back again with another installment of the FinRog series where we unpack complicated financial regulations, so you can sound smart and maybe even stay awake. Today we're tackling an important topic, the OCC's investment security regulation. But don't worry, even if you've never taken a course on US banking regulations, I'll explain everything you need to know, so let's get started. First things first, where does this rule come from? It's part 1 of the OCC rules, which means it's based on Section 24(7) of the U.S. Code. Basically, this law tells national banks how they can invest their funds. Why does this regulation exist? Well, the main reason is to make sure that national banks stay safe and sound while still being able to make money off their investments. You see, banks need to generate returns to stay profitable. Investing in securities like government bonds or corporate debt can be a great way to do that. But the OCC wants to ensure that banks don't take on too much risk in the process. So they created this rule to set some boundaries. Now let's dive into what this rule actually says. First, it splits all securities into 5 different types, based on their risk level, starting with Type 1 securities. These are considered the safest, and banks can invest unlimited amounts in them. What qualifies as a Type 1 security? Mainly U.S. government obligations, which include Treasury securities, federal agency securities, and certain other government-backed securities. The government fully backs these securities with its full faith and credit guarantee, making them extremely unlikely to default. That's why there are no limits on how much a bank can invest in them. In addition to government securities, the general obligations of states and municipalities also fall under. Type, I think of it like bonds issued by the state or city for funding public projects. Again, because these are backed by taxing authorities, they carry very little risk, hence no investment limits. Finally, banks can also invest in university and housing bonds that meet specific criteria. These include revenue bonds issued by state and local governments for qualified university and housing purposes. The OCC believes that these bonds are also fairly safe, so they don't impose any limits either. The next category is Type 2 securities. Here's the catch. Banks queue and invest more than 10% of their capital in surplus and securities from a single obligor. What are obligors? Well, basically, they're the people or entities that owe money to the bank. In other words, they're the borrowers. So if a bank buys a bond from the federal government is the obligor in that case. Now let's talk about what securities fall under Type 2. First, there are university and housing bonds that don't qualify as Type 1. We'll also find international development bank obligations, like those from the World Bank or regional development banks. And finally, there are other securities that the banking code specifically calls out. All these securities combined have a bit more risk than Type I, which is why the OCC put a 10% limit on investment per obligor. Moving on, we have Type 3 securities. Once again, the investment limit is 10% of capital and surplus per obligor. What kinds of securities are we talking about here? Mainly corporate bonds and municipal bonds that don't fall under Type 1 or Type 2. For example, think of bonds issued by companies or cities for various projects. Not like Type 1 and 2, banks can only buy and sell Type 3 securities. They can't underwrite or deal in them. Underwriting basically means helping an entity raise funds by buying their bonds or other securities and then reselling them to investors. Banks typically do this for a fee. Dealing, on the other hand, involves buying and selling securities for the bank's own account. The OCC restricts these activities for Type 3 securities to limit the bank's involvement in the securities market. Next is Type 4, which has no percentage limits. These are small business-related securities that are backed by pools of loans. This category also includes commercial and residential mortgage-backed securities, which are assets that are secured by numerous obligor pools. Think of mortgage-backed securities as bundles of home mortgages that are sold to investors. By investing in these, investors receive payments based on the underlying mortgages in the pool. The OCC considers these securities relatively safe since they're backed by multiple obligors, which spreads the risk around. Finally, we have Type V securities. These are investment-grade marketable securities that are fully secured by loan pools. The twist here is that no single issuer can account for more than 25% of the bank's capital and surplus. In other words, the bank can invest up to 25% of its capital in securities from one issuer, but not more than that. The 25% limit applies to both the principal amount of the securities and their market value. What exactly does investment grade mean? Well, it indicates that the issuer has enough money and a low enough default risk to meet its financial commitments. For example, a BBB- rated security would not be considered investment grade. As for marketable securities, they must either be registered with the SEC municipal revenue bonds, Rule 144A securities or ISOLE, sold with reasonable promptness at fair value. The term fair value generally means the price at which the security can be sold in an arm's length transaction between market participants on the valuation date. Okay, so now that we know the 5 types of securities, let's look at some critical definitions. First, what does investment grade mean? Remember earlier I mentioned that Type 5 securities had to be investment grade? Well, this simply means the issuer has enough money and a low enough default risk to meet its financial commitments. In other words, it's a fancy way of saying that the issuer is unlikely to default on its debt. To be specific, the minimum rating for a security to be considered investment grade is BBB- by Standard and Poor S or BAT 3 by Moody's. Next, what does marketable mean? Marketable securities are those that can be easily bought and sold. So think of stocks and bonds that trade on major exchanges. These securities are considered liquid, meaning they can be quickly turned into cash without significantly impacting their price. To be specific, marketable securities must meet one of the following criteria. They are registered with the SEC. They are municipal revenue bonds. They are Rule 144A securities, or they are readily sellable at fair value. Rule 144A securities are a type of bond that can only be sold to institutional buyers like banks and mutual funds. These securities are not registered with the SEC, but they are considered liquid enough to be classified as marketable. Finally, the definition also includes securities that are readily saleable at fair value, meaning that they can be sold quickly without significantly impacting their price. For example, U.S. Treasury securities are always considered marketable because they are highly liquid. And finally, what's the definition of capital and surplus? This is important because it affects how much a bank can invest in different types of securities. For most banks, capital and surplus refers to the sum of paid-in capital, retained earnings, and all reserves, and is often referred to as total equity. However, for community banks with less than $1 billion in assets, capital and surplus is calculated differently. In this case, it's determined by multiplying total assets by the appropriate leverage ratio specified by the regulatory capital requirements. The leverage ratio is a measure of a bank's capital relative to its assets and is used to ensure that banks have enough capital to cover potential losses. Next, what's the definition of related obligors? Related obligors are entities that are connected to each other in some way. For example, 2 companies that are part of the same corporate group would be considered related obligors. The OCC looks at these entities together when calculating the limits on how much a bank can invest in different types of securities. Another important concept to understand is the combined limits. The combined limits are the maximum amount that a bank can invest across all types of securities from related obligors. The combined limits are 100% of capital and surplus for Type 2 and 3 securities, and 100% of the lesser of capital and surplus, or total capital for Type 5 securities. In other words, the combined limits vary depending on the type of security. For Type 2 and 3 securities, the combined limits are 100% of the bank's capital and surplus. For Type 5 securities, it's 100% of the lesser of capital and surplus, or total capital. Total capital is the sum of all capital accounts, including both common and non-common equity. Now let's talk about who needs to comply with this regulation. All national banks must comply with this regulation. State banks that are members of the Federal Reserve System must also comply to ensure a level playing field. Additionally, foreign banks doing business in the United States through their U.S. branches must follow these investment guidelines. When it comes to enforcement, the OCC has the authority to examine banks and take corrective action if necessary. If the OCC determines that a bank is violating this regulation, they may issue a cease and desist order, impose a fine, or even revoke a bank's charter in extreme cases. So there you have it, a breakdown of the OCC's investment security regulation. This regulation ensures that national banks maintain safety and soundness, while still being able to invest in a variety of securities. The tiered approach allows for both conservative government securities and more diverse investments within carefully controlled risk parameters. Thanks for watching. Please like and subscribe for more videos. And check out my page for more study guides and resources. Thanks again, and see you next time.